They say the market hides its secrets in plain sight, but only those who think like a composite operator ever learn to see them. Have you ever wondered why prices seem to explode after you exit, or collapse after you finally buy in? That's not bad luck. That's structure. That's manipulation by design. Before you comment the market's rigged, ask yourself, what if it's not rigged against you, but designed to test whether you truly understand how professionals think? Comment your thoughts below, because this is where most traders either wake up or wash out. Let's start with a hard truth Richard Wyckoff discovered over a century ago. Price doesn't move because of news. It moves because of money. And money, real money, doesn't announce itself. It hides in accumulation. When Wyckoff studied the tape during the early 1900s, he wasn't chasing headlines or patterns. He was chasing intent. The intent behind volume surges, quiet ranges, and those suspicious false breakdowns that lure the public into panic selling. He realized that behind every stock's movement was a single orchestrator, the composite operator. Not one person, but a collective representation of smart money, institutional investors, syndicates, and insiders, quietly building positions while the public argues about price targets. Wyckoff spent decades decoding this invisible footprint. He didn't have charting software, indicators, or social media noise, only ticker tape and intuition sharpened by obsession. He watched price and volume print like a heartbeat. He noticed something astonishing. Before every major uptrend, there was a calm, a sideways drift filled with fake breakdowns, high-volume rejections, and exhaustion selling. He called it accumulation. To the untrained eye, it looked boring or bearish. But Wyckoff saw life beneath the surface. He saw professionals testing supply, shaking out the weak hands, before marking up prices in what appeared to be a surprising rally. And this is the heart of hidden accumulation. The appearance of weakness conceals true strength. Take the 1907 panic. The market was blood red, financial newspapers screamed catastrophe, and the public dumped shares at record pace. Yet Wyckoff noticed something strange. Volume surged on down days, but price stopped falling as much. That meant someone was absorbing all that panic selling. Within months, prices reversed violently upward, and those same stocks everyone abandoned became the leaders of the next bull market. Sound familiar? It should. Because that same behavior repeated in 1932, 1974, 2009, and 2020. Every time the crowd shouted, "End of the world," smart money whispered, "Buy quietly." But why does this deception work so consistently, even today? Because the market is a psychological ecosystem, not a mechanical one. It thrives on imbalance between fear and knowledge. Wyckoff's genius wasn't just in identifying accumulation. It was in recognizing the human cycle behind it. The public is emotional. Institutions are strategic. When fear spikes, the crowd wants safety. The composite operator wants inventory. So accumulation becomes theater. It's the act of professionals pretending to be uninterested, creating false signals, and forcing retail traders to surrender their shares at bargain prices. Wyckoff used to say, "If you can't tell whether the market is being accumulated or distributed, you have no business trading." He meant that your success depends on whether you can think like the operator, not like the victim. This first step is awareness, seeing the market not as random chaos, but as a story of intent. Every chart is a narrative. First accumulation, then markup, distribution, and markdown. If you don't read the opening chapter, you'll never predict the ending. As Wyckoff would put it, the tape tells all, but only to those who can listen. So let's listen. In the next section, I'll pull you inside the psychology of accumulation, the inner conflict between what you see and what's actually happening beneath your feet. Because the market's biggest moves don't begin when it's loud. They begin when it's quiet. Every trader wants to buy low and sell high. But when the market finally offers that chance, it never feels like one. That's the paradox Richard Wyckoff obsessed over. The best opportunities always appear the worst. Before you scroll down, ask yourself, if you saw your favorite stock collapsing for weeks while financial media screamed bear market, would you really have the conviction to buy? Comment your honest answer below. Accumulation doesn't shout, it whispers. It happens when traders are too scared, too distracted, or too numb to notice what's really going on. Think about the anatomy of a typical accumulation phase. At the start, the market has just crashed. Retail traders are angry, shell-shocked, or over-leveraged. They want revenge trades, not patience. Meanwhile, institutions, those who must deploy capital, start quietly taking the other side. But they can't buy everything at once. They need liquidity. So they use fear as bait. Wyckoff called it the shakeout. It's the part of the cycle that feels like despair. Prices break below obvious support levels. Social media fills with panic posts. Analysts downgrade the same stocks they once hyped. You tell yourself, I'll buy when it stabilizes. But when stabilization comes, it doesn't look like safety. It looks like boredom. And that boredom is where most traders lose the plot. During accumulation, volume patterns tell the truth more than price. You'll see wide spreads down on high volume, signs of institutional testing. But the closes start inching higher. Each sell-off loses intensity. The downswings dry up. That's absorption. Smart money is absorbing supply, while the crowd waits for confirmation. Wyckoff's case studies were brutal in their honesty. He showed how the composite operator builds positions against public emotion. In 1921, while most traders feared another depression, professional operators were loading up on steel and rail companies. By 1923, those same stocks had doubled. Why? Because the crowd sees risk where professionals see value. The human brain hates uncertainty. It seeks patterns, even when none exist. That's why people chase breakouts and dump in breakdowns. They want validation, not probability. But Wyckoff's teachings flip that instinct. The true test of conviction is whether you can act before validation arrives. He used to describe it like this: when you buy from a discouraged seller, you're buying from emotion. When you sell to an eager buyer, you're selling into emotion. That's accumulation and distribution in a single sentence. The inner conflict every trader faces is this: do you trust what the chart feels like, or what the structure tells you? The structure doesn't care about your fear. It doesn't react to headlines. It reflects behavior, supply, and demand in its purest psychological form. Let's break it down with modern context. Look at 2020. When global markets collapsed, retail traders fled. But during that March-April range, price stopped making new lows despite record volume. That was composite activity, absorption again. By the time most traders regained confidence in July, smart money had already marked up 40%. Or take 2022 to 2023, when tech stocks bled out. Meta traded under $100. Sentiment was apocalyptic. But inside that base, institutions were accumulating shares while the public screamed, "Dead company." Fast forward a year, and Meta's price more than tripled. Same pattern, same psychology, different decade. Wyckoff wasn't predicting magic. He was mapping human behavior, the repeated loop of fear, disbelief, hope, and greed. Every accumulation range is a battlefield of emotions. The crowd wants certainty. The professionals want liquidity. Both sides can't win. So the composite operator manufactures pain. He needs to shake you out before he can move price. He'll create false breakdowns, trigger stop-loss cascades, and let algorithms amplify the panic. It's deliberate, because your exit becomes his entry. And here's where most traders crumble. They confuse discomfort with danger. But Wyckoff taught the opposite. Discomfort often signals opportunity. He said, "Study the motive behind movement, not the movement itself." The motive behind a violent drop inside a trading range isn't always bearish. It can be the final test before markup. This is the paradox of accumulation. The composite operator pretends to sell so he can buy. The public buys comfort. The operator buys chaos. By the time the crowd feels safe, the opportunity's gone. Every great rally is born from disbelief. And by the time the world finally believes, it's already too late. Before we wrap up, tell me this. If you could spot accumulation before the crowd ever noticed it, would you have the courage to act? Drop your answer below. Here's where Wyckoff separated students of the market from followers of noise. He believed accumulation left behind a trail, a hidden rhythm between price, volume, and intent. And once you learned to hear it, you could see the market story unfolding in real time. The final phase of accumulation is the spring. The market dips below support one last time, volume spikes, and traders panic. It's that "I'm done with this stock" moment, the point of maximum disgust. Wyckoff called it the terminal shakeout. It's the market's psychological purge. Professionals use it to test supply one last time. If the selling dries up immediately and price recovers swiftly, the test is over. The markup phase is about to begin. He didn't guess. He read the behavior. Volume told him when the composite operator was finished accumulating. Tight price spreads with rising closes showed demand quietly overpowering supply. A sudden sign of strength, an up bar breaking resistance with commitment, confirmed that absorption was complete. In modern terms, it's when volume expands on rallies, contracts on pullbacks, and the market refuses to revisit old lows. The public thinks it missed the bottom. Wyckoff would say, "No, that's the beginning of the campaign." Look at history. After the 1932 lows, Wyckoff himself noted how the Dow's recovery began with subtle higher lows and tightening ranges, the same pattern institutions used a century later during 2009 and 2020. Different eras, same blueprint. The smart money never changed its tactics because the crowd never changed its psychology. Here's the uncomfortable truth. Accumulation isn't a pattern. It's a process of deception. The operator must convince you that the asset is worthless so he can accumulate it quietly. Only when his inventory is full does he let the truth out. That's when the media flips bullish, analysts upgrade targets, and retail traders start piling in. But by then, markup is well underway. Wyckoff described it as the law of effort and result. Every rally must be preceded by sufficient effort, heavy volume, wide volatility, and emotional exhaustion. When that effort no longer pushes price lower, the result is inevitable: higher prices. This is why Wyckoff's principles remain timeless. They're not about predicting markets. They're about reading the behavior of those who move them. And that's the mindset shift most traders never make. They chase signals. Wyckoff chased motive. They react to price. He anticipated purpose. They sought comfort. He sought control. Learning to think like the composite operator means abandoning your emotional need for certainty. You stop asking, "Is the market bullish or bearish?" and start asking, "Who's in control right now, and what are they trying to make me believe?" That's when everything changes. You begin to see accumulation not as a chart range, but as a conversation between predators and prey. Every false breakdown, every quiet test, every sudden surge in volume, it's all language. And when you can finally translate that language, you stop trading with the crowd and start trading with the professionals. Wyckoff's story wasn't about discovering a system. It was about reclaiming your objectivity in a marketplace built to exploit your impulses. He once wrote, "The market is made up of men who will do to you what you would do to them, if you knew how." That's the essence of accumulation: awareness over emotion, intent over impulse. So next time you stare at a stagnant chart, remember, stillness doesn't mean nothing's happening. It often means everything is. The question is whether you'll be the one being shaken out, or the one quietly shaking others out. What's the hardest part for you? Waiting through boredom or buying through fear? Comment your truth below. I rid everyone. This is how Richard D. Wyckoff saw markets, not as chaos, but as choreography, fear, and greed performing on a stage designed by professionals. Once you learn to see the footprints beneath the noise, you stop reacting and start understanding. Because the biggest edge in trading isn't prediction, it's perception.